You're listening to Inside Real Estate, your source for all things mortgage and real estate related. The show that brings you all the hottest topics and insights directly from those who know it most. Now sit back and enjoy the show.
What do you guys think? You think it's time to change the intro?
I think so.
You think so? I want the audience to
Something
kind of
fresh.
to let us know. Go to our Facebook page or go to irepodcast.com. Send us a comment. I want to know, should we change the intro, or do people like it? Do you think people like it?
I don't think it matters.
Okay. Sal, nothing matters with Sal. Hello, everyone. Paul Apostolakis, Salvatore Cusavano, Brad Weisgerber. We are Inside Real Estate. Today is just us. We do this from time to time. We generally have a lot of guests come in and out of the studio.
A little break once in a while is good.
It would, for us to kind of just talk about, the market, mortgages, and kind of from our perspective a little bit more. Weird day today. We walked into the podcast studio. We did not know that the room got flipped around.
Yeah.
And it's totally
nice.
different. I don't know if you could tell if we're streaming live, if you can tell, but it is backwards, so it's kind of throwing us off. And we also started late because we made a mistake. It happens. Yeah, it happens. Streaming live is always kind of...
We learned from the mistake, though.
So anyways, long story short, we are here. We are talking mortgages. We're going to talk about the interest rate environment right now. We've got some questions from listeners from across the country and world, which is interesting. I'm always blown away by, did you know that our biggest market other than our local market here in Michigan is California and San Diego?
Yeah, and Sweden.
Actually, Sweden fell off.
Oh, it did?
Yeah, Sweden fell off a little bit. We've got...
No love.
So let's talk about, first and foremost, I do want to get into, there's a lot of things happening in the market right now as far as interest rates. A lot of people are refinance applications had gone up. They've gone down a little bit since, but, interest rates yesterday, Sal, hit like the lowest I've seen in a long time.
Yeah, it's pretty insane.
Like you told me yesterday, give me an example. You gave me an example yesterday of a deal you did for a friend of yours. What was it?
It was like 3,625 on a 30-year.
No cost.
Yeah, I mean, granted, it was a large loan,
right?
So like typically the larger the loan, the easier it is to, give credits and whatnot.
Why is that? Can you explain that?
So when you're doing a refinance or a purchase or whatever, right? When you have a very large loan, the rates pay out a static percentage, right? So let's say you're putting 20% down. The house is $100,000, right? So that's an $80,000 loan.
Not a lot of meat on that bone.
No, because essentially, as a lender, let's say that pays 2%, right?
Mm-hmm.
That pays $1,600,
right?
So,
but that same 2% on $500,000,
right? It's $10,000,
$10,000, right?
Right, and
what we call yield spread.
Yeah,
right?
well, it used to be called yield spread.
Well, it
right?
still is,
no, it's rate premium or whatever. But either way,
It's still the yield spread.
You as a lender, right, and most lenders, just to be competitive, they don't need to make $10,000 on a loan, so they can pass that along, right? So hey, you can take this rate and get a $4,000 credit, right? Or you can essentially, if you want, you can keep all that as a lender as long as your client's sold, which is not really good practice. But essentially, you have to get competitive, right? So you got to lower your margins. So the margins aren't necessarily static as to what lenders want to make on a deal, right?
Yeah. And the thing for consumers to understand is that those margins are different from lender to lender depending on what incentives they get. If they're a direct lender, some people have higher margins, have lower margins. It is crazy on the back end what a lot of consumers think.
Lenders always ask, or borrowers always ask, how do you get paid? Right?
Yeah.
Essentially, that comes from.
If there's no
rates.
cost, how do you get paid, right?
Right.
Well, we
it's
get
all
paid
rolled
off the
into
rate.
Yeah.
That note rate pays back, 4% note rate pays back X, and we can pass along the revenue back to you, or we can keep it.
Or
Who
3.87.
determines what it pays back? I don't understand.
That's we get that a lot. So the margins are set by the company a lot of times. What do they want to make per loan? Like if you go to Quicken, for instance, I know they've got large margins. Just to be fair, they do a good job, but they have large margins, and their rates are generally higher because they make a lot more money per loan because they have to pay for a lot more things.
Right.
So just to give you an idea of how that works, now what we're seeing a lot now is a lot of people talking about refinancing because rates are so low, and I think there was a study out. There's like 8 million
Well, it's always
homeowners. Go ahead.
Sorry, not to go too far off that, but that's a good question. What is the rate, right? But there is no rate, right? Like what's the no point rate, right? What's the rate that doesn't give you a credit or pay a cost? We can determine that, right?
Yeah.
But the rates are whatever's best for your deal.
Just so everybody understands, when we say no-cost refinance, there are still costs involved. You still have to do title. You potentially have to do an appraisal. You have to do recording fees. There's still costs involved.
Yeah, if you were a borrower and you don't have any money for closing costs,
right?
Like, you shouldn't be trying to get the lowest rate.
Right.
You know, you should be looking at, like, okay, if I take a quarter point higher in rate, how much is that going to save me up front?
So let me explain that too to the consumer, because here's how it works. If let's say at 4% or 3.875, it costs $3,000 to do that mortgage. You can do 4% or 4.125 and get rid of those costs by getting a credit for that rate because you go higher in the note rate. And what's happening a lot right now is a lot of people are looking at refinancing, and what we're doing as a company is we're doing a lot of no-cost refinances. And the reason we're doing no-cost refinances, here's the beauty of no-cost refinances, is there's no recoup time on that investment, right, Brad? Right. So like if I paid, let's say 6 months ago, I paid $3,000 to refinance. 6 months later, rates go down, and I could save $50 a month. You're probably not going to do that because you haven't recouped that $3,000 that you already paid, right, on that investment.
I would do it if it's a no-cost refinance.
Correct. So that's the trick. Now, if you refinance 6 months ago and you did it at no cost, rates go down in 6 months, you do another no cost. Rates go down another 6 months. In 6 months, you do another no cost. You keep riding the ladder down and giving yourself. Now, a lot of people are like, I want the best rate. I want the best rate. I want the best rate. Well, that's not always you can get the lowest rate possible in the country by paying for it. You could pay what's called discount points to get your rate even lower. It doesn't make a lot of sense because it's the investment. So this is how I look at it. If it takes you, let's say you pay $3,000 and you pay whatever the numbers are, but it takes you 5 years to recoup that cost. That's like saying if you gave me $3,000 today, and in 5 years I'd give you that $3,000 right back to you. That's a horrible investment.
Yeah.
Right? That's when you break even.
Depending.
Yeah, depending on your goals.
Like, let's say you're going to be in the home for 20 years.
Yeah.
Right?
Yeah, but
and it might be it's too hard to speculate, I think, and agree with you. But it could play out to be a good investment if rates never get as low as they are today.
Right.
But that's unlikely.
Every person's situation is different. Everyone's goals are different. Everyone's reason to refi is different. So like if you know for sure certainty that you're going to live in this house for the next 20 years, 30 years, forever, right? Yeah. Not until the kids are all gone and you're time to downsize when you're 50 or 60 or 70. Then you might not want to do it low cost because you might want to get that low rate as low as possible because in the long term you're gonna recoup that investment. It is an investment, right? You're gonna pay some costs now to save in the long run because if you take a higher rate, you're paying it in interest over the term of the loan, right?
I get that,
but for most people, they refinance or they move or they don't stay in a mortgage.
Something happens
more than 7 years. So it's I think it's 5 to 7 years or 4 to 7 years right now is the average that someone stays in a mortgage. So if you can refinance at no cost and leave your future open and not invest that money because shit happens. You don't know what's going to happen, right? Refinance every 6 months at no cost. Do it for sure.
Yeah, dude, we've had
save the money for free.
I have people that bought a house a year and a half ago that I've refinanced 3 times since then.
Me too.
All at no cost.
Yep.
And they're always like, we're doing it again. I'm like, dude, you don't have to do it, but you're saving interest. You're saving $50 a month, $100 a month, whatever it may be.
Why
it's
wouldn't you?
Free money. Yeah. What happens is if you don't refinance to take advantage of the market on the way down, unfortunately, what you're going to end up doing is, you pay the bank more than you should. Your house ends up costing you thousands of dollars more than it should over the life of the loan, and you're not managing your debt correctly. Here's the way I put it, and like I can't stress this enough. If someone had a 401k and they were like, "Hey, man, I can guarantee you a 0.5% higher in return over the next 10 years," would you do it at no cost?
Yeah, but how many people even look at their 401k? I don't even know what mine is.
Well, I think some refinances you have to think about, right? And some are no-brainers.
Sure.
That one I was talking about, they're saving $420 a month.
Yeah, it's
Dude,
stupid.
It's insane.
For free.
And they just refied in December.
Right.
Whoa.
Well, that's the thing.
He has to pay his loan down $1,500 to get the appraisal waiver, which I don't think it would ever appraise. It's kind of crazy. But
we can talk about that.
But with that being said, I mean, okay, he has to pay it down $1,500, which is equity, so it's not really a cost, right? And then his closing costs are actually zero.
All right.
We were able to give him a credit to cover all the costs.
What
was a big loan.
But I'm going backwards in my mortgage.
Yeah. I don't want to keep resetting the clock over and over again, Sal.
Well, you just reset it 6 months ago, and now you're saving $400 a month.
And I'm going to set it.
So if you want, make the same payment, and you'll pay. It's probably like a 24-year AM.
But there's solutions for that too. You can do a 29-year mortgage now.
Yeah. Not everywhere.
Right?
Well, you could do that if you want, and instead of saving $420 a month, you save $390.
Right, whatever it is.
But you stay on track to pay it off in this
You have to
amount
look
of
at it, because all you have to do is pull up an amortization schedule. If you wanted to pay off your current mortgage in 1 year, well, you can do that.
Yeah.
You just
There's
have
no
to figure out what the
penalty.
payment is.
Right.
So ultimately, as long as
absurd.
you're paying less interest and you can figure out that you're not going backwards, it's nice to have the flexibility of a 30-year.
Yeah, absolutely.
Hey, I'll tell you what the payment is for a 26-year, because let's say you're 3.5 years into your mortgage. But if you want that flexibility of a 30-year, we can do that. You just have to make the same payment if you want to stay on track.
Right.
It's all up to the discipline, and that's another thing when talking about mortgages is escrows, right?
Mm-hmm.
It's like,
Hate escrow.
are you disciplined enough to pay your own taxes and insurance? Because if you are, your payment will actually never change.
Never.
And people always say, oh, it's a 30-year fix, my payment will never change. Well, the principal and interest portion won't, right?
Yeah.
Your escrows will. And sometimes it can be brutal.
It can be, you can get hammered.
A lot of people don't get that. A lot of people move into a house, and I've seen this happen multiple times, and they're like, hey, this is my payment I want to have, blah, blah, blah. They get into the house. A year later, their house gets assessed. Their taxes go up 2 G's a year, 3 G's a year, 4 G's a year, depending on where
Let's
they're
say
at.
it went up $2,400 a year.
Yep, that's $200
$200 a month. So
Yeah.
if you have a shortage and the mortgage company pays it, they will adjust your new payment to reflect the $200 that it's going to be.
And
then
add
Plus,
the
plus the
$200 shortage over the next 12 months to make up for that escrow shortage. And that's just one of them. Let's say you get reassessed again in the winter and that one goes up $1,200. Now you're
insurance goes up
$300,
too, yeah.
$600 higher.
Just for those that don't totally
insane.
understand what an escrow is,
12 months.
an escrow account is money that is held into a non-interest bearing account that you pay into every month to pay for your taxes and insurance.
Not interest bearing for the borrower.
Yeah.
Yeah, true. But basically, like it goes into account and it pays for your taxes and insurance when it comes due. And it makes it easy because you don't have to think about it. The drawback with that is a lot of people don't look at their tax bill when it comes out.
Yeah.
And what happens is the servicer might not adjust your taxes properly to the new
6
tax.
months later.
Right. What happened to me. And I'm actually...
It happens all the time.
Yeah, it happened to me.
happens
I've
almost
got a
everywhere.
shortage. My payment went up $400 a month.
Think of the madness of escrow.
It's
It's
madness.
crazy. But
Different loans closing every different day. So there's a different due date for insurance all the time.
Yep.
Right? All over the country, different tax due dates, the way they're paid, this and that. What a nightmare.
yeah.
Yeah,
You
some
know.
are paid in the rear, some in the, they're all
It's a
over the
nightmare.
place. Yeah, from county to county they're different. From city to city they're different.
Back to every person's situation is different. A lot of people, I've actually refied some people this year that had an escrow shortage and didn't want to cover the new payment because it was going up $500 a month to cover the shortage in the new
Happens
tax bill.
all the time.
They refied, did an escrow waiver, got out of their escrow account, and saved money.
Well,
on it.
right now,
they
now
don't
that
have
the
to deal
new
with the
tax
escrow
bill is out, it is a good time to cure that shortage, do your new refi, have your new payment, everything's all set. You don't have to worry about it, or waive the escrows. I mean, again, if you are disciplined to do it and you know that that's going to happen, I always tell people, listen, set it up, right? You have direct deposit from your,
set up a separate bank account.
yeah,
It's just
open
called
up another
nickname
account at
escrows.
Chase or whatever.
Do your own escrow.
Yeah,
Certain,
and every month
paycheck.
have, $150 out of each paycheck go into that escrow account, and then you have the money, and you don't have to worry about it.
Yep.
It's still the same concept,
But unfortunately Americans are not great savers.
well,
And you're getting interest on it.
not to mention it's a little
Yeah, I mean, not
complicated,
much,
especially
but-
if you're a first-time buyer. Like you'll see, like a lot of older buyers or people put a lot of money down. I'd rather do that separately, right? It's like, yeah, I get it. I mean, I want to waive my escrow account just because it's like, it's annoying.
It's
Right?
super annoying.
Hey, your payment's going up. It's going down, and then it goes down, and then all of a sudden they're like, "Oh, sorry, we lowered it too much."
Yeah, but then you got to call the service. It look in a world where some people are smart enough to do it, or like I'm not. I know myself. I don't know. I just would rather it's just paid. But at the same time, the better way of doing it is controlling it yourself. That way you don't have to worry about all that stuff.
I'll do your escrows for you for a nominal fee.
You're the controller at a company.
But I don't do your own. I'll do yours for a nominal fee.
You get paid too much.
Escrows are super complicated. Avoid them.
Here's the funny thing that we come into. Then this as a borrower, a lot of people go into the conversation. I want the lowest rate, and they're like demanding their will upon the situation. And if you're a consumer, just listen to your if you're working with someone that you trust and believe in, listen to them, because you don't know more than we do. We get stumped on stuff, and we've been doing this for years and years and years, and we see hundreds
Crazy
and hundreds
shit.
and hundreds of mortgages every single day, and we still to this day something will pop up, and I'll look at Sal. I'm like, dude, have you ever seen these? He's like, no, bro, what is that? And Sal, Brad's like, oh, that's kind of fucked up. You know what I mean? Like, like the mortgages aren't black and white. They're very nuanced, and they're not like they're not really like really well put together. There's a lot of things that can go wrong in a mortgage. Like
Many things.
There's so many things. There's so many moving parts, and they're not perfect. And the mortgage market is there for us to be able to buy and sell houses. At the same time, people sometimes think they know more than they do, and they just like give me the lowest rate. I saw on Bankrate.com that blah 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 I could get this. Right? What do you say to that guy that says I saw on Bankrate and they're giving me this offer, and then I mean, how do you combat that?
Maybe they are.
Yeah.
I mean, that's fine. I don't know. If you want to explore that, you can. Here we are. We already have everything all put together. I implore, if you really care that much, call them, right, and see if that's what they're actually offering. It's easy to bake fees in. It's easy to roll the costs in. Maybe they are giving that deal, And if you want, you can find another deal better than that.
You'll always find a better deal
deal. But people
somewhere,
who kind of delineate and they're like, I don't know if I want to do this, or maybe there's another rate cut coming, or maybe, I can find a better deal here or there. And then all of a sudden the rates go up a quarter point and it's like, hey, let's go with you. I called so-and-so and they're at 4 and you told me 3.875 or something.
Well, they went up.
Sorry.
That's what people understand.
Now we're at 4 1/8. So take that 4 from them.
You're trying to get the people are. This is another thing a lot of consumers don't know or maybe not understand. Rates change daily by moment. They're like a stock; they go up and down every single day. So if you're trying to hone in on one rate and you're shopping, let's say you're shop for a week straight. Well, the person you talked to on the first day and the person you talked to on the last day, they're totally different markets. So you're trying to hit a moving target.
Yeah. I mean, as a consumer, you should be educated by someone, right?
Hopefully,
hey, well, they probably aren't, right?
Yeah.
But knowing that it's a market, it's like, hey, so-and-so said they could buy me Ford stock at, $14 a share. Well, the next day you talk to another broker, they're doing it at $13 a share. Well, of course you're going to go with the cheaper share, right?
Mm-hmm. But it wasn't anything that.
But
that
yesterday they were
did,
the same, right?
Yeah.
You have to look at things as apples to apples, which is kind of like the same time frame. But above and beyond that, if they're close enough, work with who you think's going to get it done.
Right.
Yeah.
Work with
what's
someone that's
good a
gonna,
rate that you can't close on?
Work
or that
with someone
takes,
that's going to add value, because you can get the same stock from multiple different brokers. You can get the same car from multiple different dealerships. But who's going to add value? Who's going to make sure your tires are inflated, your fluids are full,
But I think
you have
the
support
most
down the road?
I hate refinances. I mean, I love them and they're good for people,
Yeah,
but I
so
just
definitely love
it's a moving target constantly. Well, am I rolling costs in? In the end, you might roll a couple $100 or pay a couple $100 because we don't. Or we could change the loan amount to exactly match it last second, but that amount that you owe changes daily.
So yes, this is something that we need to talk about, because people
It's
are always
too hard
like,
to time.
What are the numbers? What are the numbers? What are the numbers? Here's the crazy thing that I want people to understand, and we don't know the numbers because we don't know exactly how much interest you owe on the old loan. We don't know exactly when the taxes are due. There's so many like things that change. Just and here's another thing people that might not understand is that when you make your payment on your mortgage, that payment covers the interest for the last 30 days. Because when you made the last payment, every day since then, you accrued interest. And when you make your next payment, you pay that interest from back then. So people are like, well, I owe $100,000 today.
My mortgage statement says my balance is $102,000.
Right. Well, you accrued interest for the last 20 days. You actually owe more than that. So your payoff, when people get their payoff, not only is it good through like that day, but it's also good through a few weeks past that, just in case, right? So
and we usually pad the payoff a few days, just
Correct.
because it takes
Banks
time
suck.
to send a wire. It takes time to send a check.
Right.
And then it takes time on that bank's end to cash that. I had a deal where it was absolutely insane.
Yeah.
We sent a wire for like $720,000.
Yeah.
And they're like, oh, they accepted it, which is crazy. Then, they took 4 or 5 days to post it, and then they said it was late. And it's like, well, you received, oh no, they didn't do a wire, it was a check.
Yeah, it was a certified check.
They got their FedEx confirmed delivery on a Wednesday. They posted on a Monday, and oh, sorry, you owe a whole nother month's interest or something. It was insane. I mean,
Sal
it's
and I
like,
lost 5 years of our lives doing
Yeah.
that.
But I mean, that just goes to show you professionals are even like it's hard for us to really fix. So when
it's
someone
just a crazy industry.
So a lot of times people will get to the closing and they'll be like, wait a minute, I wasn't expecting, I thought it was no cost. Why am I bringing $1,000 in? Well, you didn't pay last month's, you're skipping next month's payment. You got to pay that interest,
Right.
right?
Well, yeah.
You
And
know?
it depends, right? There's certain things that you owe, right? As a consumer. Like,
As a homeowner.
hey, you told me that it was going to be $2,000, it's $2,600. Well, yeah, but now you don't have a mortgage payment till November,
Right.
right?
Right.
And
But
that
you
is-
still, but here's the thing: people think, oh, no mortgage payment. You still accrue interest because there's not a moment that you live in that home and you
Not a
have
single
not
moment.
a single moment that you. Right now, right now. I just accrued interest. I could accrue more interest.
Yeah.
Every moment of every minute
But
of every
what's-
day, I'm accruing interest.
And if you fund early enough in the month, you can actually get a credit for that interest.
Yeah.
But you'll make your payment due 1 month earlier.
Yeah.
So that will help on costs, right? But if you have to look at it from a consumer as also like a cash flow thing, right? Hey, it's going to cost me $3,000 to close. My payment is only $1,700. Yeah, but then you don't have a payment till November, so it's actually saving you yeah.
And to be fair, here's a big problem in our industry are
$400.
actually loan officers themselves. Because loan officers, unfortunately, sometimes because they want to get the deal, they're like, oh yeah, it's gonna be good. It's gonna be perfect. Here's how much you're gonna have, and they're like, these are the numbers. These are the numbers. That isn't fair to the client to not explain to them, hey, here's what could happen. Yeah. We're overestimating, but this could happen. This could happen. These numbers aren't static. They move. It's a moving target. That's the proper way to kind of frame it. But what happens is in our industry where some people are very transactional and they just want to get that deal and go to the next deal, and then all of a sudden they don't understand what's happening. These people end up still closing, but they're lost the whole time, and they're like, "Why did I do this? Why did
Right, and it still might make sense for them.
But yeah, but they're not.
But they don't
happy.
know what
Yeah.
the hell they did.
They have no
I
idea.
paid a lot of money, and
They
my
feel like I
payment
got
went
cheated.
down $50.
Yeah, dude,
right?
Yeah, they don't know what happened. They don't understand it. So, for anybody listening out there, if you're looking at refinancing, make sure that you're just dealing with the person that's going to explain all this stuff to you, and be faithful in the person. If they tell you the hard truth, like sometimes I tell people things they didn't want to hear, and they're like, "Well, that's the other guy told me something better. I'm going to go with that guy." Well, it's harder to be honest.
Yeah,
in our industry, it is much harder to tell you the truth. Because the truth is a little bit dirtier, a little bit more muddled than just making it sound all sexy and,
Right.
and nice, right?
Yeah, it's kind of insane. And, on a different note, just while I'm thinking about it, if you have equity in your home too,
Yeah.
like now's a good time where you could probably do a cash out refi, even if you refied in the past year, and keep your rate the same and
Get some
structure
extra
structure some debt. Because most people, right, work on a pretty consistent basis of what they get paid, right?
Yeah, they
Like-
got salaries, they
Yeah,
got hourly.
they got salary, hourly, maybe a little bit of fluctuating overtime or commissions, but for the most part, you have that monthly nut, and you have what you bring in. So think about it like if you're paying $400 or $500 on, $20,000 of debt a month. I mean, it's going to take you 5 years, 6 years to pay it off, and that could be that's an installment loan. You might have 20 G's of credit card debt. Unless you're paying like $1,000 a month at that, it's never going to go away. I mean, it's going to take you 7-8 years or whatever to pay that.
The minimum
off,
payment
right?
takes
If
you
you
30 years.
just-
If you do
It's insane.
the amortization on a credit card, minimum payments take you over 30 years to pay it off.
Yeah.
Think about that. So for good LOs out there, I know they look at themselves as debt managers because that's what we're doing. We're managing debt. And if you have equity in your house and you have other debt, there's something to be said to be able to combine all that in a very low tax-deductible interest on some level and put yourself in a better financial position. And you can pay off your debt much faster that way, especially if it makes financial sense. Again, there's a lot of different ways to utilize your mortgage and your equity in your home for the benefit. The danger is using your home like an ATM. What'll happen is you pay off someone's debt, and then 6 months later, they racked it up again.
Yeah, don't refi your home so you can take a vacation.
Right.
Unless you're going to take some type of crazy 2-month, 3-month vacation.
Once in a lifetime
Yeah.
experience vacation.
Yeah, don't.
Because it does us no good. Like for me personally, and I know us as a company, we're very cognizant of like putting people on good loans, right? Because ultimately, the health of this market is dependent on the mortgages that we do. If we start seeing a lot of delinquencies and people doing a lot of this stuff,
You
it's
shouldn't
not
have to
Yeah.
sell the facts of a refi. You have to explain them,
Right.
but you shouldn't have to be like, dude, this makes total sense. Like, it should be like, wait, what? So I'm going to save $200 a month basically for free
if it's
and not
explained
start my
correctly.
mortgage over.
Right.
Yeah. So
Right. But big question we get all the time is, what's the catch? I don't trust that. People don't trust it. It's because it sounds too good to be true. Wait, I pay no cost, and you're going to lower my payment, and people like short circuit. You know what I mean? They're like, that's not possible.
the catch is that we're a for-profit business and we make money on it.
We will make money on it. Yes, that's what.
But-
yes.
Unless you want to, we will not roll any costs into your loan, right? You won't pay any costs if the rates can cover the costs, and all you have to bring is your escrows or waive them and literally bring nothing.
Right.
You know, and they're like, well, that doesn't make that's just how it works. So, I can help answer any of the questions, but look at your balance, look at what you owe, look at your current rate, look at the other rate, and are you starting over on 30 years, or are you doing a term? I mean, a lot of times right now, especially people who did a 30-year mortgage in the past year or two, we're bringing them down to 20, and they're paying like an extra $100 a month.
Yeah, and look, it is on some level self-serving when we call a client and we're like, "Hey, man, you can refine it," because we do make money on it. I don't want to even pretend like we don't. That's not even like a
We
fair.
typically don't make a lot of money on them.
We make less.
Right.
We make a lot less on those, of course, but at the same time, we do make money on them, and we are going to reach out because it helps us as a business, and also gives us an opportunity to help the client. It's very good on every level. Like, everybody wins, right?
I think if you come to a point like, listen, I love and I tell this to people who I don't want to write their mortgage because it doesn't make sense. Like, we make a living writing loans. I don't want to write yours. It doesn't make sense. I'm trying to drop PMI. I got a, $60K mortgage. I'm at like a 4.25. I heard rates are 3.75. Yeah, you could do that, but it's going to cost you $1,800. Imagine if you just paid that divided out over the term.
Right.
It doesn't make sense.
We say no all the time, and I think there's a lot of power in no. You know what I mean? Because if it doesn't make sense, dude, a reputation isn't worth someone saying, "Oh, dude." It's unethical, to be honest with you, to put someone in a mortgage just to put someone in a mortgage because they feel like they need it. It's a lot better for us, and I think the consumer, to hear, look, man, right now is not the right time. So refinancing is a big deal right now. So obviously, talk to someone if you're listening. But I've got some questions here from listeners that I want to go through because I think it's nice to have listeners ask us questions. It's really nice.
Yeah.
Yeah.
Where can they send questions?
What's that?
Where can they send questions?
You tell them.
If you want to send us a question for a future episode, you can email us at info@irepodcast.com. Hit us up on a Facebook chat or just text Paul. His number is 2. I'm just kidding.
It's public. It's 586-242-2468. Get after it. Gosh, I'm gonna get like some crazy calls, dude. I mean, my number is not exact. I get so many spam calls. Okay, so I've got Margaret from San Diego. She asks, "What are discount points, and should I pay them?" Sal, I think this is a good one for you.
Kind of hit that.
Yeah.
So discount points, and it sounds funny because you think, and it really didn't hit me for like the words for what it's worth until yesterday. For some reason, we were looking at a loan, but a discount fee, right? You'd think it'd be like a credit, but it's the fee you pay.
Oh, I'm getting a better deal.
Well, it's a fee you pay to get a discount on your rate.
Yeah.
Right. So, and they're
It's basically prepaid interest.
evaluated.
Just so everybody knows.
Yeah, they evaluate it in what are called points. So points are 1% of
Your
the
loan.
loan amount is 1 point. So on a $200,000 deal, 1 point costs $2,000.
Does it
Right.
drop my interest rate a full percentage?
It can sometimes. So the points change every day, and the difference between rates sometimes can be very advantageous to pay points, and sometimes they can be very insane. Like, why would you do that, right?
It costs $4,000 to
and
save
there's
an eighth.
thresholds between rates. So it might be like, all right, listen, for $500 you can buy down from 4 to 3.875. It saves you $18 a month.
That recoup
That's a
times-
no-brainer.
Yeah, that's good because
Right?
your recoup time is good, right?
But to go to 3.75, it costs another
$2,000.
$2,000. Yeah, and it only saves you another $18 a month. Right.
So
Well,
that
that doesn't
recoup
make
time is no
sense.
good,
So
right.
you have to look at the options. Like when your loan officer calls you and asks you, if they do you want to lock your rate in? Right. Well, what's the rate? 4%. Okay. How much does it cost to buy down 1/8 and 1/4?
Right.
Past that, it usually doesn't make sense unless, for some reason, on small loan amounts, obviously at one point on an $80,000 loan is $800.
Still, though, the savings is still the same, though, right? Proportionally, you're saving maybe $3 a month.
Yeah, to a degree. I mean, it depends. You got to look at it. Sometimes it does make sense, because on a super large loan, I don't think it's proportionally the same because it's amortized over 30 years versus what that costs up front as a percentage. So it is different, but
what I want consumers to really have a look out for, though, on that market, just so you know, is a lot of times you'll get quoted an interest rate because people are so fixated on getting a low rate. Let's say you get quoted 3.5%, and you're like, oh man, I got a 3.5%, but it costs you $14,000 to do, or $10,000 to do.
Yeah, nice,
right? But people don't look at that sometimes.
Well, people who pay points in December I'm calling them now, and I'm like, hey, I know you wanted to buy the points. I know it was like the deal at that time, right? You paid $3,000. Those are out the window, and this is what I was talking about, right? So this time around, we're going to do the 0-point rate, and we're shaving your rate half a point. They're like, wow, man, sucks. But it is what it is. You can't recoup those points if you sell your house or if you refinance early.
Right. I'm not a big fan of points right now, the way the market, the buy downs aren't great. Sometimes you get some value propositions, like 500, like whatever it is. Most of the time right now, points for me are not, because the recoup time is too long. We're in a falling rate. I don't think it makes sense.
Vice versa, though, you can get a great rate still and get credit towards your costs. Let's say you're buying it, just because the rates went down doesn't mean all of a sudden you have an extra $20,000 in your bank account, right? Like as a purchaser. So let's say you're wanting to buy a house, and hey, you're quoting rates out 3-4 months ago when you're kind of kicking around, and it's like 4.375, 4.5 with 3% in closing costs. Well, now it's like, okay, you could get that same rate and have your closing costs for free. So if you're cool with that payment, you can end up getting 2-3% towards your closing costs.
Right. Next question. Ready? Donald in Seattle says, why does it take so long to close a mortgage? Generally speaking,
you have a poor lender.
No, that's not true, because he said when I open a credit card, it happens instantaneously, right? So he's wondering, basically, he's like, why does it take up to 30 days?
It's the property.
What's that?
Most of it's the property.
Right. It's always different. So mortgages are super complex. That's why it takes longer than a credit card or a car loan, because there's a lot of different parties involved. There's a lot of moving parts. There's a lot of work that has to get done, and a million things could go wrong or throw a wrench in everything and slow the process down.
Yeah, I mean, but typically, right, like underwriting, if you have everything that you need and you collect it all up front, that's actually pretty easy.
Yeah.
Right? Like if you're a W-2'd employee, pay stubs, W-2, ID, bank statements showing you have enough money. I mean, that's pretty much it, right? Good credit. But when it comes to the home, you have to get title work, right? Because, I mean, who knows from the time that last person bought that house until now what had happened, right? They might have put an addition on, and now that's leaned on there. All of a sudden you own the home. So you have to get title work, you have to get insurance, you have to get an appraisal. Like, those are the items that take money or time, right? Because
not to mention on the property that was old mechanically, and you've got to get clear. I mean, there's a lot of things.
Not to mention the borrower that goes out and buys a new car in the little process or quits their job.
Yeah, don't do that. Don't.
Oh, I got a new job offer.
A lot of times
I quit yesterday.
It is borrower
you're not
borrower stuff, right? Yeah. Like they owe money or what.
And the reason for that is it's piss poor preparation. Like you weren't told or foreshadowed the process of how things are going to work throughout the mortgage process, so you don't know any better. So you get a job offer, you're going to quit your job and start a new job.
It is, though, too. It's not bad. I mean, a lot of times a seller, they don't want to sell and close, like, hey, we're going to put our house up for sale. All right, you get an offer. Hey, we closed. We want to close tomorrow. I mean, that's just not how it's going to work.
Right.
Even if the loan could be done in one day, it's still probably like, well, we need, 45 days before we want to close, or, if there's occupancy or whatever. So it's kind of like it is what it is.
Remember back in 2014, 15, Bank of America was taking 90 to 120 days to process a refinance.
It happens, yeah.
Fucking crazy.
Yeah.
I mean, some lenders we work with right now are 2 weeks in underwriting.
Yeah.
I mean,
with the rise in volume comes some pain in the turn times on a lot of things, right? But if you try to head it off as much as possible, and I think our average is 22 days, which is still a while. And this whole idea of an automated mortgage where you push button get mortgage, I don't see that
things are crazy when the biggest lender in the country is backed up to 4 or 5 days in underwriting.
Right.
Yeah.
Because they have a massive staff.
Mm-hmm. Right. We got a question from Susan in St. Clair Shores. What are closing costs, and how much should I expect them to be?
Well,
Well,
I mean, closing costs typically like the costs, right? Any lender fees, right? Underwriting fees, origination fees, points, processing fees. Then you have
Third-party fees.
third-party fees that like, hey, the appraiser has to get paid, right? If this doesn't go through, they're not going to go out and do an appraisal for free. So you got to pay that. Credit report, that costs money. Flood cert, they got to make sure that the home is, free and clear from being in a flood zone.
Title you've got states like Florida, New York that have taxes placed on when you do a mortgage, right?
Tax stamps.
Yeah. Tax stamps. Try to do a mortgage in New York. Those taxes
Right.
they're massive.
Yeah, I mean, they're different everywhere, but a lot of people also think, I know when most consumers ask me, they want to know what's it going to cost me,
Right.
right? But you have to look at things as sunk costs, and then you have to look at other things like down payment as obviously
Not a cost.
I mean,
That's
it
your
is
money.
a cost to your wallet. but
Escrows, not a cost.
Not-
Technically, if you look at the
it's
paper,
an out-of-pocket,
yeah.
but
if
it's-
you look at the piece of paper, your
it's a
loan
prepaid,
estimate,
it's taxes,
it's a
insurance.
part of your closing cost calculation.
This
But
is
it
how-
is not a cost. Every human that owns a house has to pay
Yeah.
taxes.
And then within
insurance.
those costs, there's also third-party costs that are necessary, like we said, title work appraisals.
Yeah.
And then you have lender costs, origination, points, that kind of stuff. So the lender cost is really what you want to focus on a lot of times because the third-party costs pretty much are static. They're not going to be
Depending
that
on
far
the
off.
lender, I mean, it's typically good to say if you're escrowing, right, between the tax prorations because you have to pay the seller back, right, and your escrows, a year of taxes, a year of insurance, and probably another $2,500.
That's pretty typical.
right?
Yeah.
So
That's pretty typical.
and you might buy a house that's $150,000. The taxes are $5,000.
Yeah.
What? Costs are like 6%.
And here's the funny
Yeah.
thing is,
It's brutal.
Other than the escrows, if you buy a $100,000 house, it costs her about, let's say, $2,500. You buy a $300,000 house, it might be $3,000. They're not.
Yeah.
The
They don't change
Yeah.
dramatically.
Right. So the percentage
Pretty
of
static.
The most
cost-
expensive loans are the smallest ones.
Yes,
Yep.
because it's still title work costs the same, appraisals cost the same. So percentage of loan amount is much higher on the smaller loan sizes, whereas a $500,000 loan.
Well, that's why, with a $500,000 loan, right, with a half a point credit,
Cover everything,
yeah.
more than everything.
But
Yeah.
back to the story about interest rates and discount points versus taking a higher rate. You can do that on a purchase too. It's not just refis. You can take a higher rate on a purchase to help cover some of those
Right.
sunk costs.
If you have a good
can't cover your down payment, but you can cover your escrows, your taxes.
Well,
you can cover your title work and stuff.
nowadays, especially if in a competitive market like the seller, if you're buying your first house and let's say you have, your down payment saved up 3%, you can't get a gift from family or anything like that. You're reliant typically on the seller to pay the closing costs,
Yep.
right? So in that circumstance, you might go in and hope for that and ask, because obviously you would want the lower rate, but that might not happen. It's competitive. Hey, they got another full price offer on the table. Okay, well, we're going to go in without that. What other options do you have? We'll talk to your lender. You can buy up the rate and essentially get credit towards that cost. Can you come up with another $1,500 and the lender will cover the rest? Yeah, and that's typically how it will go.
Yeah. So next question, Leon in Frisco, Texas asks, I recently was denied a mortgage due to the fact that my self-employed income went down dramatically last year due to some issues he had apparently. And they basically said that he is not qualified due to the disparity in his lowered self-employed income. Self-employed income is an interesting thing. Give the audience an example. Sal, myself, and Brad all started the company a year and a half ago, right? And because we're self-employed less than 2 years, and the way that it was structured, we can't refinance, and we own a mortgage company.
Yeah.
And we're paying over market on our interest. My interest rate's
Isn't it
4.6%, right?
Mine's 5.5.
Mine's 5.5, 5 3/8.
Right. So
It's
think
insane.
about that. We can't. I mean,
I
we're
could save $250 a month.
Yeah, I can
and
save
pay
like 400
and put
bucks a
money in
month.
my pocket still.
yeah.
It's insane.
Yeah.
But when it comes to self-employed, you have to realize that you're only as good as your last year. And at least on paper.
Yep.
Doesn't matter if you murdered it this year. Great. Call me when you do your taxes.
Isn't the rule if your income declined by more than 25%, that's the issue?
It depends. Depends on the lender, the underwriters, but generally it's a 20% swing. If a 20% decline, they're gonna request more information.
Really?
Yeah.
But,
I mean, I've always gone off qualifying just off worst
case. Yeah.
Yeah. It's 5% worse. All right, we're using that lower year.
Yeah. If you look at the last 2 years,
It's declining.
and the most recent year is way worse than the previous year, well, you have a declining trend, right?
Now,
so it looks
for
like you're
those
going to
of-
make less money this year based on
Right.
the trend. So
Now-
you're going to use the worst case and use the lower amount.
And then above and beyond that, sometimes like FHA, they get a profit and loss.
Yeah, they want
right?
to see what you're doing this year.
So
yeah.
if your year to date doesn't even match up with the year before, you're screwed,
You
right?
got big problems.
So on the flip side, sometimes it's great if, let's say, hey, 2017 was like, okay, I just opened my business. 2018, we killed it, right? And we're killing it right now.
you're not going to
Do
use.
I have to average that like $6,000 net that I made in 2017 versus my like 80 that I did in 18?
Yes.
Not necessarily.
Well,
If DU
underwriters are still going to use the worst case, right? Unless
No.
you can get by with 1 year's tax returns.
That's what I'm saying. If
Yeah.
if you know the system allows you to, you can use 1 year tax returns sometimes.
Yeah, you can. But okay,
Typically good credit and like 10 to 20% down or more.
So when people look at their self-employed income, what are they looking for? Because it's, a lot of times people say, "Oh, I didn't make much money last year," and then we look at it, and they make a lot more based on our calculation. There's a lot of things on a
Well, there's certain add backs.
right.
Yeah. Certain
You know.
things that you write off as a business expense, we can add back as part of income because it's you're writing off the expense, but that's really a cost of you being in business, right? It should have been income to you.
Yeah.
Like you write off for business use of home, right? You
Well,
use your house.
Listen, if you're self-employed, especially like a Schedule C, right? Meaning like just a small LLC, you don't have like an
Sole
S corp
proprietor.
or anything, right? Like, if you know consciously when you go to file your returns that you didn't pay anything, and that you didn't pay anything throughout the year, you're
gonna have a hard
probably
time.
not going to qualify for a mortgage. If you're like, yeah, hey, every time I get paid $10,000 a month. I put $3-4 grand away for taxes. You'll probably be in good shape.
It's a real hard thing for self-employed people because you want a good CPA that's gonna work within
communicate with your
the gray
CPA
lines
and
of
say,
the
listen,
tax
I'm trying to
code.
buy a house in the next year or two.
Yeah, you got to tell them. You
Okay.
got to have that conversation.
Yeah. Well,
I
maybe
need to show more income, less write-offs, so I can qualify for a home.
But
And
then
you
I
got
have
to
to pay
plan
The
ahead.
IRS
but
isn't
then I
going
have to pay taxes.
You absolutely have to. That's
The IRS isn't going
made
to
money.
slap your hand for showing less than you even if your write-offs are true to bring you down to zero. The IRS won't slap your hand for paying taxes.
Right.
They will the other way around.
Yeah.
Oh yeah.
Yeah. Yeah. It's well, I had a client once, just a little off topic, who paid themselves a $120,000 salary a year out of their company, and off that they would have qualified perfectly, but they owned 100% of their business, and their business showed a $300,000 loss.
Ouch.
And they didn't qualify, and they were angry at me, like, well,
What do you? I got a $120,000 salary. I don't understand. Why,
Yeah, but
why
you're-
does my business have anything to do
because
with it?
your business is what's
You also
paying you.
can't just
Exactly.
You also, if you own the business, you can't just like or work for family. You
I'm
can't
gonna give
just all of
myself
a
a
sudden
raise.
get a raise.
Yeah.
Yeah.
It doesn't work like that.
Yeah,
which
underwriters
sucks.
are smart to that. So a lot of times, what's happened lately is I've heard this before. Like, oh, I work for my father, and I'm like, well, you don't make enough money. Well, he's going to give me a raise. No,
Yeah.
it's family. They're going to look into that. The underwriter's going to look, and they're
They look
they're
at
savvy to
trends.
that. They're going to say, hold on a second. His father owns this business. He was making $30,000. Now he's making $120,000. There's a lot more common sense in underwriting than people think.
Yeah. They look
Yeah.
at trends.
And sometimes there is common sense that helps people. I did a USDA loan where guy's making double what he did last year, and I was like, oh man, I didn't know he worked for family. So after the underwriter there's always questions you learn as an LO that you should ask up front. And
Yep.
when you get burned, hey, did you file your taxes? Hey, do you work for family?
Mm-hmm.
Hey, do you have any unreimbursed business expense, whatever, right? When that was a thing, but like it can make sense, like, hey, now you're doing a completely different job, different tasks, it's paid all differently, show us
Yeah.
pay stubs from the beginning of the year. It's just too easy to fudge when you can control that.
The trends and the common sense can work negatively against you, but can also work positively for you. So if you're a borrower looking and self-employed, have an open and honest conversation with your loan officer because your loan officer is
don't
not
hide
the
anything.
underwriter.
Don't hide anything.
The loan officer needs the information to best present your loan file to an underwriter. And if he has all the information, he might be able to make a common sense argument to give you more income because something changed, yada, yada. But if he doesn't know that, the underwriter is just going to look at it and say, this doesn't make sense, denied.
But also, you also want to hear the no if it's a no early.
Right.
You don't want to get into contract, lose your EMD, be 3 weeks into it, have your shit packed in the back of a bus in a van.
Well, and let's be honest too. Most underwriters,
I was just lost my room.
most underwriters are not very experienced.
This is
know,
true.
Truth.
They have a
That is
calculator
true.
that they plug stuff into.
Yeah.
They don't until you really dive into tax returns, you don't even know how a business really works.
Right.
You know, well, I just know that I put depreciation here. I know that you don't even know what a distribution means, right?
As
You're
an
just like,
underwriter,
well, it's
yeah.
more income. You just plug it in the calculator, right? But
Yeah.
you know, you
That's
have to-
unfortunate, but it's
well,
reality.
wait,
yeah.
but then when you get granular and you talk to a experienced underwriter, well, they write this off because of that. So why are we hitting them for this liability?
Right.
We can kind of work.
But it takes a good LO to be able to navigate that and have that
yeah,
conversation.
you got to get burned.
You do have to get burned. Yeah, you do have to get burned. Okay, next question. It's kind of on the same vein. So Tiffany in Richmond, Virginia said, I was 1099 and now I moved over to a W2 position. Can I buy a house? This is kind of interesting. This is like backwards, I think, but it's
Yeah,
Yeah, you can. Well,
depending on the W2
depending on
position.
depending on the circumstances, yes,
Is
because
it-
a W-2 is, so 1099 is you work for yourself, you're self-employed, right?
Mhm.
Essentially,
people don't get that though.
1099 you are working for yourself.
Like my wife is 1099. She gets paid by the government.
You're
really.
an independent contractor. You're working for yourself.
She
It's
gets
not a
paid-
guaranteed paycheck.
Correct. You are self-employed.
W-2 is a guaranteed paycheck. You go to work, somebody pays you for working for them. You get a paycheck. You get a W-2, taxes are taken out of it. 1099, you're an independent contractor. You're not guaranteed
Right.
a certain amount of hours or whatever. You might have a contract or a gig you got going on, but that could end anytime.
I think to answer Tiffany's question, the big thing is, can you show a 2-year history of working, right? Can you show us 2017 and 2018 tax returns and now you're working as a W-2? And what are the circumstances? Are you going to a full-time commission job? Because no, you cannot, right? Are you getting paid, per job? Like, let's say, like I had a question yesterday. Hey, someone's a masseuse, right? And they get paid for every time they do a massage. Well, what does that translate to hourly? Because you have to calculate an effective income, right?
Yeah, I mean but here's the thing. Can't you? Let's say I got a job tomorrow. I'm on and I'm getting paid. I got a salary of $100,000. I can use that to qualify without any history.
It depends on the loan, but yes.
No previous history, but let's say you never worked,
That's what I'm saying.
No, you can't.
Yeah, you can.
Yeah, you can.
Yeah, you can. That's the craziest thing about it. Let's say I had a baby and I didn't work for 7 years, right?
Did you work before you had that baby?
Potentially, or let's say I didn't work at all. If
Ever?
I didn't work at all, you can still get a mortgage. See,
Right, the more you know. Well, conventional?
Conventional.
that's
Yeah.
what's a little odd about the mortgage process is that if you're self-employed for 5 years and you had one bad year, you're denied. If you went from 1099 to being
Not FHA, because I battled that beast.
yeah, I'm just saying.
Well, at least with the 2-year thing.
Yeah.
I'm just saying. I mean, there's
FHA is a little weird.
these are like just very like there's always caveats to like that's the weird thing about mortgages. We might say something, but there's like a loophole somewhere that if like in this certain situation that we can figure out how to get.
There's a
done.
loophole in every situation, man.
Everything.
That was a hard word to say.
Yeah.
What word?
Situation.
No, there really is. I mean, that's what I always, somehow get to sleep with is you might be doing a deal that you're like, dude, it's done. It's not going to work. Like
Toast.
it's great. But
Then
then
you wake up in the morning with a fresh mind and you're like, I found
or
a
you talk
loophole.
to someone and you're like, all right, we can do this. And it gets you that much closer. It gets it done. So it just depends.
A lot of that is the reason that our jobs are exciting, though, is being able to solve those puzzles, right? I like that
a lot
part
of
of the
problem
job.
solving.
I like that
Exciting,
part
I
of the
guess.
job.
A lot of problem solving. Okay, next question. We're going to move on. So Brandon and I don't know if La Jolla.
La Jolla.
La Jolla. Is it La Jolla? Have you been there?
It's in
It's in
San
California.
Diego.
Yeah. So Brandon La Jolla says, what is the difference between a pre-qualification and a pre-approval?
That's it's a great question, and a lot of times they're interchanged.
They're used
They're used incorrectly, right?
incorrectly.
So
Yes.
a pre-qualification and a pre-approval. So pre-qualification means I talked to Aunt Tilly at Joe's Mortgage Hut, right? And I told him I made $100,000 a year, and I got good credit, and they said, okay, you're pre-qualified. Here's a letter saying you're pre-qualified. They didn't look at anything. They didn't verify anything. I just told them what I made, and they gave me a letter. Now I can go buy a house and
I
get
may
under contract.
pre-qual someone without a letter. I wouldn't give them an actual letter.
Yeah,
right?
a lot of people
but
do,
Hey,
though.
based upon what you told me, it sounds like you'd be in good shape.
Right.
Right.
But a lot of people actually give them a letter, and they go shopping
Which
with
is
that.
crazy.
And it really puts you in a bad
Things
position.
people make it makes the LOs must think it makes the client sticky to them, right? Because it was easy to get, but it's like
That's a horrible setup.
think if you're a realtor and you got a pre-qual letter.
So the difference is pre-approval.
I can't believe that I get calls from real estate agents that are like, "Well, did you pull their credit?" No shit, I pulled their credit. It says it on the fucking letter.
Yeah, it's a pre-approval.
You know? But I can understand why.
Yeah. So a
Right?
pre-approval is different than a pre-qual. A pre-approval is you sent some kind of documentation has been verified, your income, they pulled your credit, they looked at your assets, right? They've done the beginnings of what an underwriter would do, right? They looked at your qualifications, and based on everything you provided and verified with them, you are pre-approved to buy a house. There's always certain contingencies at the bottom of a pre-approval. It's got to go through underwriting. You got to find a property.
Well, that's why it's
got to
called
appraise.
pre-approved and not approved.
But it's actually,
But you want to
it's
do the
better
due
than a
diligence.
pre-qualification because
Yeah.
they have verified the information that you gave them over the phone. You provided documents, they looked at them, and it looks good.
If you're buying a house and you haven't sent in documents to your mortgage company, and if they haven't put you through a little bit of pain to get that pre-approval, you probably
You're
shouldn't
doing it
feel great
wrong.
about it. You're doing it wrong.
We get a lot of, a lot of worry, a lot of anxiety from, well, am I good now? Are we good? I'm like, listen,
You're never
Are
good.
you
till
mad?
yeah.
we're good.
Are you
but
mad?
literally, this has not 100% chance of closing until you close and it's funded.
yeah.
You know?
Exactly.
A good
It
mortgage
is-
company will do their absolute best to avoid any issues up front. That's the trick.
But they're going to make it, they're going to
They
do their
come up,
best to
though.
avoid the issues
They
down the
still will
road,
come
but they're
up.
going to make
Yeah.
it really painful up front
Hey, we get
for
an
you.
updated bank statement and we see a deduction in there for $450 a month. It might not be an issue, but underwriter sees it. What's this?
Right.
What's this payment to Ford?
Yeah.
It's my husband's. All right, no big deal.
Right.
Oh, I bought a new car.
yeah.
Yeah. It's not my
Well,
credit
fuck,
report
you
yet.
didn't tell me that.
Right.
You know?
Right. Or you
And
get-
granted, I mean, sometimes it's on the LO to ask, but it could take me 2 hours to go through something with someone to get everything just for a pre-approval if you want it to be that solid.
And here's what
know?
gets screwed up all the time is a LO will get a pay stub hypothetically, right? And on that pay stub, there's $800 a month in child support being deducted that they don't look at.
Right. You just look at the gross. All right.
Yeah,
you're good.
he's good. He's good. He makes 60
look at the
G's a year,
deductions.
and then he's marginal, and all of a sudden you get into underwriting. Wait a minute, what's this $800 a month? And you're like, what are you talking about? Well, it was on
The pay stub
the pay stub,
deductions.
right? So you have to be critical and look for
You
these
gotta
issues
ask good
prior.
questions.
Yeah.
Or, like I said earlier, did you file your tax return?
But some people don't want to ask
I've had
questions.
deals where, hey, we got to close in a week, and oh shit, I never filed 17.
Mm-hmm.
What?
Mm-hmm.
We just did your whole 2018 tax, talked about it, we knew you were paying him this week, and no big. Yeah, I didn't do 17 though either.
This is single-handedly.
Pony up.
This
Get
is
the check.
Yeah, this is single-handedly the biggest reason why Quicken Loans has a bad reputation with real estate agents on the purchase market, is because unfortunately their LOs, and I'm sorry for saying this, but this is the reality. They get a lot of pressure to write pre-approvals, so they're trying to write as many as possible, and they're not doing the due diligence. And a lot of times these deals have issues that could have been rectified up front.
Well,
And I'm not saying all LOs there.
and
There's
simply the
but
volume of deals, you're
That's
going to
what I'm
have
s-
ones that go bad.
correct.
The
but
more you do, I mean, the more propensity there is
and
for
you
things
have
to go bad.
the acumen. There's there's pressure. The acumen. They're not there's a lot of moving parts there. So just make sure that you're on that pre-approval when you get that piece of paper. That should mean something. And if you don't feel like you went through enough, like if they were, you know what I mean.
I feel like they've gotten a lot better.
they have.
you know?
Yeah, they have. I think
And
because
it
they
just
had
comes
to.
down to training and, you
Yeah.
know, probably hey, we wrote, 500 pre-approvals, but we only closed 20 of those. Hey, we probably got to figure out a different pay structure.
Yeah.
You know?
I feel like the pre-approval process is very similar to getting in shape. It should be painful when you first start. You should have to put some work in and go through some hard times.
Agreed.
But so by the time you're a week, 2 weeks in, and you're getting towards that finish line of where you want to be in your workout or whatever, it's easy because you put the work in up
people
front.
are afraid. Well, so and so said that did they even pull your credit? No. Well, you're not actually approved. Well, I know. Come on, man. But listen, if you're not willing to work with me up front so that I can make sure this is a good process for you.
But as a consumer, you just want to hear you're good. You know what I mean?
Sure.
So on some level,
well, let me tell you that you're good.
Yeah.
Let me get that a surety.
But what's happened before is I'll tell someone, I'm like, listen, you've got an issue here that we have to fix. Well, he's like, well, ABC Mortgage didn't tell me that. I'm going to go with them.
Go with them.
Go with them, but it's going to
blow up.
It's going to blow up.
You're gonna hate yourself.
And you know what? Once in a great while,
It doesn't. And
It
gets
doesn't,
bad. Yeah.
and they're like, "Yeah, I closed."
Okay,
Perfect, man.
perfect.
Great.
Good
Happy
job.
for you.
Worked
I
out.
am happy
Yeah,
for you.
yeah,
but
yeah.
I'm
Because it
not
would have
willing,
been. I would.
I'm not willing to take on that risk.
No.
Right?
Like we talk about all the time, Sal. If you got on an airplane and you're flying over the Atlantic and you're going to Europe or whatever, and the captain comes on, he's like, "Hello, everybody. Please buckle up. We've got a 60% chance of making our landfall."
Imagine your pipeline is a Greyhound bus, right? And people
Oh.
get on stops and they get off, and
Yeah.
you're trying to go around.
This is good. Okay.
Some guy comes in and he's got a vest on with dynamite in it, and you're like, "Yo, we got to get rid of that dynamite, or you can't come on my bus."
Well, he's
Right?
like,
And
I
they're
won't set
like,
it
well,
off. I won't set it off.
I can go ride on the smart bus then, or whatever, right? Well,
Yeah.
I'm gonna let you do that because if that blows up, I don't want my whole pipeline to get fucked up over it.
This is a great analogy, right? And if
I want people to come on and come off.
And if he makes his
I
destination,
don't want anyone to die on the bus.
If he makes his destination, good for him.
Hey, great. If
I
that
don't want you
didn't-
on my bus, though.
If for some reason your clicker on your little detonation device
doesn't go up.
doesn't go off, great. But I don't want you
I
on
don't
my
know
bus.
if suicide bombing is a good analogy right now.
It kind of is a great analogy though, right? Because someone always told me, at least when we were at UWM, let that bomb blow up in someone else's pipeline.
That's a pretty wow.
And it sounds shitty because those are people
That's
who are
so
trying to
true,
get
though.
Approved for a home loan, but hey, I don't feel like I'm going to get it done.
Yeah. It's not,
And it's going to take
it's-
away from what you can do in the service to your other clients if you can.
It's not fair to your other clients. It's not fair to you, and it's not fair to that client
Right.
themselves. It's just
If you don't
doing
feel
the
good
right
about
thing.
it, don't do it.
Don't do it, man. Don't do it. And I mean, that's just the truest statement possible. So, Jessica, how much time do we have left? I know we started a little late.
I think we're
We got about
done.
5 minutes. Okay, so we'll start wrapping up. So yeah, I mean, there's as you can see, we could probably do 100 of these shows, and we've got what? How many years have you been in the business now, Sal, in mortgages?
8.
8 years. Brad?
7. I don't know.
You know,
7.
I'm going on my 17th year right now. So
But you're old.
well, hold on a second. That's not my point. Thanks for pointing that out. But what I'm saying is, even between us collectively, in our office, we've got a very seasoned group. We still come up against things, and we're like, things we've never
When
seen.
guidelines change, right?
Everything changes.
Could you
Like
always
just
do
this
the
week?
2 years no employment, right? Or hey, you start a job tomorrow and you can't do, you can have 0 work history before.
It's always been like that.
Okay.
As far as I know.
Yeah, I don't know. I always thought, but again, there we go.
There we
right?
go. It's
Right.
just on the show, we just Sal learned something.
Yeah,
It's interesting.
it's good.
Yeah. So do you guys know? By the way, our podcast, knock on wood, has been doing really well. We had Barry Habib's show, just is the 3rd most listened show that we've ever done, and that happened very quickly. That was a very good show. If anybody wants to listen to that show, it was very good.
Which one?
The last one,
most recent
the
one?
most recent one. Yeah,
He's been on twice.
Yes, he has been on twice. Where do you think our top 3 outside countries that listen to us?
So other than the United States?
Yeah, obviously.
Canada.
Canada's up there.
Yeah.
Sweden's still up there?
No, Sweden dropped
No?
off. Sweden's way-
Australia?
Australia's in there. Yeah, Australia's in there.
Spain.
You just looked at my screen. Yeah, you just looked at my screen.
España.
It's pretty crazy, right? We've done this little show that we do out in Royal Oak, Michigan. Gets listened to all over the place.
Gets out there, gets around.
Yeah, yeah,
Dirty show.
yeah.
No.
Does anyone have any questions for me ever? Jessica, do you have any questions for me?
No, I've got nothing. I'm too tired. Sorry.
That's it. We're done. Are we done?
I think we're good.
We're good.
I think
Brad, you've got to shave your beard.
I know, bro. I meant
I don't know
to-
what's going on with it. There's I don't know if you shaved parts of it and then forgot to finish it.
No,
Tough.
Joe Dirte. I get that whole I meant to
Joe
last
Dirty.
night. I meant to last night. Didn't happen. Meant to this morning. Didn't happen. It'll happen today.
It doesn't look great.
I agree. It's terrible.
At least you're not as hungover as that one episode that he
Bro.
was hungover, dude.
That's tough stuff.
Dude, when you watch the video, if you watch the playback for that episode,
I was hurting.
That was pretty tough.
I should not have gotten here.
I don't know why you came.
90% of the job is just showing up.
Not that day.
Not that day.
Yeah,
That was bad news.
Walked into work before and I'm like,
Yeah.
you got to go home.
After we did the
Hey,
show, I went
you
to the
don't look
parking
good.
lot, the parking structure, and I napped in my truck because I couldn't physically get out
No,
of
we
the
have a
truck.
picture. We should post the picture.
No,
for
we should
everybody to
not. We should never talk about this again.
Yeah.
Let's move on.
Those
All
are
right.
what's, it's funny. We don't, like, if I worked at, like, a corporation and I was like that, I'm sick.
see. Yeah.
Right? I'm not coming in. I'm
Yeah.
actually, I'm sick.
Yeah.
And I sit at home and there's, like, not a lot of responsibility or, like,
Yeah.
whatever
You don't have anything to worry
But
about.
now it's like,
I still was productive that day.
Very productive.
you
Which
know
is
what?
crazy.
I think it's,
We come to work every day. Doesn't matter. I mean,
I mean,
very rarely.
some days it's pretty bad.
Yeah.
But
You walked
we're there.
You walked to the podcast once.
Yeah.
It was a walk of shame in the rain.
That means I didn't
I
drive.
remember that.
Yeah. That was
But-
good.
Yeah.
That was good. All right, guys. Well, thank you for listening. Brett, tell them how they can find us. I know you do a good job with that.
Google.
Google us.
I mean, that's how I find everything.
Really?
Yeah. It probably is the best.
Yeah, okay. Google IRE
Bang.
Inside Real Estate Podcast. We've got some really good guests coming up going forward, guys. We're really proud of what we're doing. We thank everybody for their feedback. If you have any questions, obviously, like we said, go to info@irepodcast.com or go to irepodcast.com itself.
Facebook chat us, message or whatever.
Whatever you want. You
Yeah.
text me up here. I gave out my number. I'm not doing it again.
It's 586.
Do you know it?
Of course I know.
Let me say it.
It's your Golden Tee login.
Oh, Jesus Christ. All right. All right, guys. Thank you very much for listening. Have a great day. We'll see you next week.